Intel is scheduled to report quarterly financial results after the markets close on October 31st, 2024. That has investors asking, should they buy Intel stock before the company announces earnings or wait until after they announce to buy Intel stock? They're also asking if they should buy Intel stock at all or if they should avoid this underperforming semiconductor business. Now, unfortunately, I've had Intel stock rated as a buy all year long in 2024. It's been one of my worst picks of 2024. The stock has halved since the beginning of the year, and it hasn't worked well for the company. It looks like they overcommitted to their investment plans, their capital expenditures, spending on this big strategy shift to become a foundry and to have the latest generation technology. And it hasn't paid off yet. Investors are concerned. They had to pause their dividend because of cash shortages. It's just been a bad year for Intel. So I wanted to update that recommendation here in this video, let you know what I think about Intel stock going into earnings, and preview what investors should look out for. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so as I highlighted, Intel I've had rated as a buy all year long in 2024. I last updated that recommendation on August 2nd. And also, like I discussed, Intel stock price is underperforming significantly, trading at $22 per share when it started the year closer to $50 per share. What makes this performance look even worse is that semiconductor stocks have performed really well in 2024, given the booming demand to develop artificial intelligence and the increasing computational power required to develop AI models, etc. So, very disappointing year so far for Intel in 2024. Now, in the latest quarter, the company generated $12.8 billion in revenue, which is down 1% year over year. Intel is losing market share. Now, in the third quarter, they're forecasting revenue of $13 billion at the midpoint, so they're not expecting very much improvement from the second quarter. They continue to expect losses on the bottom line, and they suspended their dividend starting in the fourth quarter of 2024. Now, the company still reiterates its commitment to a competitive dividend when cash flows improve to sustainably higher levels. Another adjustment the company is making, given their cash shortages, is reducing capital expenditure. And with the end of its historic 5 nodes in 4 years journey firmly in sight, Intel is now shifting its focus towards capital efficiency. They're not going to be spending as much on capital expenditures. Now, one of the reasons they accelerated capital expenditures in the last couple of years is because of strong government support. Even though in 2024 they'll spend $26 billion in capital expenditure, their net capital expenditure is going to be around $12 billion, so less than half that amount. They're going to get reimbursements from the government, and also they've partnered with some private equity companies to have an easier path forward on those new manufacturing facilities. Instead of financing those facilities completely by themselves, Intel has partnered with other providers of capital to help make it not as capital intensive. In 2025, they are forecasting similar trends. Their gross capital expenditures will be about $21.5 billion at the midpoint, which would be down about $4.5 billion if they do spend 26 in 2024. So they are forecasting a several $billion decrease in capital expenditure in 2025. And then the net capital expenditure will be $13 billion. So that's the $13 billion that will come out of Intel's pocket following all of the completed investments and reimbursements from partners and governments. Now, what's making Intel's investments that much more difficult is the big decrease in cash flow from operations the company has experienced in recent years due to the loss of market share. Intel only generated $1 billion in cash flow from operations in the first 6 months of this year, and the same was true in the first 6 months of last year. So I it's hard to say $1 billion and only in the same sentence. But when you're comparing with how much money Intel is spending on capital expenditures, which is $13.3 billion on additions in property, plant, and equipment in the first 6 months alone of last year, and then $11.6 billion in the first 6 months alone of this year, that's what makes the $1 billion look like an only instead of a whopping $1 billion. So their CapEx has been 10 times higher than their cash flow from operations, and that's a bad mix. That's why they've faced these cash shortages. That's why they are pausing their dividend. That's why they're reducing the capital expenditure, making huge layoffs, cutting costs altogether, because the disproportionate amount of cash going out versus cash coming in. You can't continue at this rate. And so this is partly what explains Intel's underperformance here in 2024. And it might be some time before the company turns things around. Starting next year, they do expect to start the foundry business producing their latest generation technology, and that will help facilitate some growth for the business. Still, this isn't going to be a one-quarter turnaround. The company is too big. The businesses that it's trying to penetrate are too difficult for this company to turn things around in 1 quarter or 2 quarters. So investors that are interested in Intel stock have to be aware that this is going to take some time to turn this around. They're not going to announce anything unlikely in this upcoming quarter that's going to cause a burst in any of the company's segments. So that's what you have to look forward to. That's what you have to expect from this company. This is a long-term story. Investors need to be patient if you're willing to take this ride with Intel stock, which is a higher risk, higher return potential investment. Intel is now trading at a forward price to earnings of 20, which if the company is going to turn around and increase revenue, increase profitability, increase cash flow, it's a good valuation. However, there's a risk that the company will never do that it's persistently going to lose market share to rivals like AMD, NVIDIA, and Taiwan Semiconductor, and it's not going to recover, and it's going to continue struggling. And so that's the risk you're taking with Intel. Now, up until this point, I've said that the risk versus reward has been worthwhile, because if the company does recover, it does turn that foundry business into something meaningful, then it could have large upside. So it does have good risk versus reward still. But if you want to buy this stock, I would say it would be better to buy this stock after the company announces earnings. That way you have the latest information and you digest that latest information, and then you make a decision with Intel stock, because there are so many moving parts with this company. Going into earnings is already a high volatile situation with any business, especially so with a business that has so many moving parts like Intel does most recently. Of course, I'll have a review and several videos reviewing Intel's results when the company announces earnings, and I'll share with you what I think of the company following those financial updates. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.